Many of us struggle to choose to pay off debt or invest. Why would you pay off debt when you could put the money to work and make more money than what the debt is costing you? Is it better to use extra money to get out of debt or at least pay it down? Or is it better to invest that money so it grows and gives you a lot more money in the future? Both can make sense, but you might be surprised at how much a simple choice like this will change things. In some cases, these decisions could mean the difference between hundreds of thousands or even millions of dollars in the future. Hello everyone and welcome to Success Wisdom. In this video, we're going to talk about best way to financial success, pay off debt or invest. If you are new to this channel, do like and subscribe to the channel. Let's look at the pros and cons of each choice so you can make the right decision. The right choice could mean the difference between being completely broke and being financially free. Before paying off debt or investing, you should make sure you have a solid financial base. This mostly means setting aside enough money in an emergency fund that can only be used for unexpected costs. If you don't save money, you can't pay off debt or invest because an unexpected expense could put you back to where you started. If you don't have any savings and your car needs a major fix, you'd have to take money out of your investments or go into debt to pay for it. Before moving on, you should try to save enough money to cover 3 to 6 months worth of costs. When you have different payments for debts taking out of your account, you'll have more room in your budget. This may be the best thing about getting out of debt. Paying yourself can be hard. The more bills you have to pay, the more likely it is that you barely make it from paycheck to paycheck. When this happens, you feel like you have to go to work every day just to pay your bills and aren't making any money. Even though the amount you owe on your loan might be going down slowly, a big chunk of what you pay goes to the lender in the form of interest. Once you've paid all your loans, you'll feel like you've gotten a big raise because you'll be able to keep a much bigger share of your paycheck. If you don't have any debt, it's much easier to put more money into a retirement account, which means you might be able to retire at a much younger age. On the other hand, many people choose to invest their extra cash before they pay off all their debts. The reason for this is that the interest they make on their investments could be much higher than the interest they pay on their debts. This would let them make a lot of money. Does it make sense to pay off debt with an interest rate of 5% when you could earn 10% or more on investments? Risk is the most important thing to think about when deciding whether to pay off debt quickly or invest extra money. If you waited to invest for a long time, you could lose out on a lot of interest that would add up over time and make your money grow quickly. When you pay off loans, it's like getting a guaranteed return on your money. If a credit card company charges you 30% interest and you pay it off, it's the same as getting a 30% return on your money without taking any risk. There is always some risk when you invest. If you like this video, don't forget to like and subscribe to the channel. Can you invest in the S&P 500 and get a return of 10 or more? Yes! According to Investopedia, the S&P 500 has grown by an average of more than 10% per year since it was first created. But there have been times when the market gave a negative return, such as in 2000, when it gave back 10%, 2001, when it gave back 13%, and 2002, when it gave back 23%. After that, it made money most of the time until 2008 when it lost 38%. Long term, the odds are in your favor that you'll make a profit. But it's important to remember that returns aren't guaranteed when putting your financial plan into action. Look at the simple real-world example of paying down debt versus investing money in the stock market. Let's say that you have a 30-year mortgage for $370,000. The interest rate is reasonable, 5.13%, so you'll pay $2,016 each month. You make a good amount of money at work and have an extra $1,000 in your budget, which you can either use to pay off your mortgage or invest in. But you don't know which will leave you in a better position at the end of a 30-year loan. One option is to pay down the loan. If you pay an extra $1,000 per month toward the principal, you'll be debt-free in 15 years instead of having to pay off your mortgage for 30 years. This means you only pay $172,880 in interest over the life of the loan. And you invest not only the extra $1,000 per month but also the amount of the previous mortgage payment, for a total of $3,016 per month. If you invest $3,016 per month for 15 years, you will have $1,211,290. At the end of 30 years, when you subtract the interest you paid, which was $172,880, from the total amount you have now invested, you end up with a total of $1,038,410. Simply put, this equation is your total amount plus the amount of interest you paid. Subtracted from your total amount, you make the minimum payment and invest the rest. If you only make the minimum payment on your mortgage and invest the extra $1,000 you have each month, you'll pay a whopping $355,760 in interest over 30 years. Much more than in the first case. If you put $1,000 per month into SP 500 and assume an average return of 10%, that money will have grown to $2,079,293 by the end of 10 years. Your total investment of $2,079,293 less the interest of $355,760 gives you a total of $1,723,533. The difference between total and scenario 2 and total and scenario 1 is $685,123. This means that if you put your extra $1,000 per month into the SP 500, instead of paying down your mortgage, you'd have over $685,123 more at the end of 30 years. This is because money grows in value over time. That much money could mean the difference between being able to retire and having to keep working for a long time. This doesn't take into account the risk of investing in the stock market, and it also assumes a reasonable average return over a long time. With a 30-year mortgage, inflation is one of the best things that can happen to you. The dollar amount of the mortgage payment stays the same for the whole loan, but the dollar loses value over time. This means that you can pay back your loan with dollars that aren't worth as much as they used to be. If inflation is on average 4%, the dollar loses all of its value over 18 years. Simply put, after about 18 years, your mortgage payment will be half as much as it was when you first got it. While paying off debt with a dollar that is worth less than it used to be, you can invest in assets that keep up with or beat the rate of inflation. This gives you the best of both worlds. When it comes to deciding whether to pay off debt or invest, a mortgage is a more extreme case. There are two reasons for this. The first is that a mortgage is usually a loan with a very low interest rate, maybe the lowest you can get. In 2022, the average mortgage rate will be between 4% and 5%. That's close to the rate of inflation, which means you're not getting much for the money you borrow. Because of this, some investors even want to buy mortgages. The second reason is that mortgages are long-term loans that usually last 30 years. When a loan term is this long, the difference between paying down the loan or investing the extra money is much bigger. And it's important to think about it carefully. There are a few things to think about when deciding whether or not to pay down debt. It's not as clear-cut as it might seem at first. Cash flow is a huge benefit that can free up money in your budget. This is especially important for older investors who are getting ready to retire. Your main concern is cash flow, not which strategy will make you more money in 30 years. Risk is also an important thing to think about, and it's important to know this when choosing a plan. In general, the best way to make money in the long run is to pay off loans with high interest and use loans with low interest. You could also do both, using extra money to slowly pay off debt and invest at the same time. You should also think about doing both, using extra money to pay off debt slowly and investing at the same time. When it comes to this subject, people have strong feelings. The numbers accurately show what will happen in each case, and it's up to you to weigh the risk and reward to decide what's best for you. Think about all the pros and cons of each choice. We've reached the end of another video and thank you for watching. I hope we helped you decide to pay off debt or invest. If you like this video, do give us a like, subscribe to the channel, and comment down below. Thank you and goodbye!